We often hear about market strategies, economic indicators, and technical analysis when it comes to trading. But what if I told you the biggest factor in successful trading has little to do with any of that?
That's right. We're talking about human psychology. You know, if trading were purely about intellect, every economist with a PhD would be a millionaire. But the reality is, the market isn't interested in how smart you are. It rewards emotional discipline above all else. Today, we're really going to dig deep into the often brutal but absolutely essential psychology that underpins successful trading.
So, what exactly do you mean by that? What kind of emotional pitfalls are we talking about here?
Well, think about it. If you can't get a handle on fundamental human emotions like fear, greed, ego, or even just plain boredom, the market is going to take your money again and again without really showing any mercy. It's a very humbling environment.
It certainly sounds like it. And that reminds me of one of history's most legendary traders, Jesse Livermore. He famously made and lost several fortunes, ultimately concluding that the market was never the problem, he was. Can you unpack that for us?
That's such a powerful and, frankly, an uncomfortable truth for many traders to hear. The biggest adversary in trading isn't some external force. It's not market volatility, it's not the latest news headlines, and it's certainly not some shadowy operator. No, the real enemy is the person staring back at you in the mirror. It's about self-mastery, not market mastery. And that's often the first psychological hurdle most aspiring traders really hate to accept.
That's a profound thought. Let's talk about ego then, because it sounds like that plays a huge role here. Are traders often trying to prove something rather than just make a profit?
Absolutely. It's a classic trap, isn't it? A lot of people, perhaps subconsciously, enter the markets not primarily to accumulate wealth, but to validate their own intelligence or their foresight, to prove they were right. And that, unfortunately, is a single devastating mistake that has destroyed countless trading accounts. Livermore himself put it so clearly when he said, "Markets are never wrong, opinions often are." The instant your ego steps into a trade, your objectivity, your clear-headed thinking just walks right out the door. It's a very fine line.
So it's a fundamental difference in mindset between the amateur and the professional, really.
Precisely. If you observe professionals, they're generally asking just one simple question: am I making money on this trade? They're purely focused on the P&L, the profit and loss. Amateurs, on the other hand, are often preoccupied with, was I right about this stock? Did my prediction come true? That distinction, subtle as it might seem, is absolutely critical.
And that leads us right into the emotional pain of losses, doesn't it? Psychology suggests that losing money can hurt twice as much as gaining money feels good. How does that impact trading decisions?
It's a huge factor, and it's called loss aversion. Our brains are wired to avoid pain, and losing money registers as a significant pain. This wiring often leads to two very common and detrimental trading behaviors: holding on to losing positions for far too long, hoping they'll turn around. And conversely, booking profits too early, because that little gain feels good and we want to lock it in before it disappears.
So essentially, we're doing the opposite of what's often required for long-term success.
Exactly. Successful traders, the really disciplined ones, actually do the emotional opposite of what feels natural. Cutting a loss, even a small one, feels like admitting failure, and that's emotionally painful. On the flip side, letting a winning trade run, letting your profits grow, can feel absolutely terrifying because you're constantly battling the urge to just take the money and run. But Jesse Livermore, he understood this deeply. He didn't fear those small, controlled losses. What he feared was staying wrong. He knew that small losses are just part of the cost of doing business, and they protect you from catastrophic ones.
That takes us to patience then, which often feels like the most underrated and expensive skill in trading. Livermore had another famous quote: "It was never my thinking that made the big money. It was my sitting." Can you expand on the power of sitting?
That quote, "it was my sitting," it really needs to sink in. He wasn't talking about his brilliant predictions or some secret indicator he had. He was talking about the sheer discipline of patiently waiting for the right opportunity, and then, once in a profitable trade, having the fortitude to stay in it, to let it fully develop. It's counterintuitive in our fast-paced world, isn't it? We're conditioned to believe that constant action equals productivity. But in trading, often the most productive thing you can do is absolutely nothing.
So overtrading then is essentially an emotional addiction rather than a logical strategy.
That's spot on. It really is. The urge to constantly be doing something, to be in a trade, to be clicking buttons, it provides a little hit of dopamine. It feels like you're being productive, like you're in control. But more often than not, it leads to impulsive decisions, higher commissions, and ultimately losses. Patience, on the other hand, while it feels passive, is genuinely what pays dividends in the long run. It's the silent killer of overtrading.
And that leads to a harsh truth you often hear, that good trading is actually quite boring. Can you elaborate on why that's the case?
Oh, it's absolutely true. If you're coming to the markets looking for constant excitement, for that thrill, I'm afraid trading is likely going to destroy you financially. The market has a very distinct way of punishing those dopamine seekers, and conversely, it richly rewards what I'd call discipline addicts. The pros, they spend most of their time waiting, analyzing, doing their homework, and then executing with precision. The amateurs, however, they're often just clicking, chasing the next high, the next story. There's a huge difference in approach there.
And it sounds like part of that discipline involves understanding crowd psychology. Markets aren't always logical, are they? They often move on mass emotion, fear, and greed.
You've hit on a critical point. While economic fundamentals are important, the short-term and even medium-term movements in markets are largely driven by collective human emotions, that powerful ebb and flow of fear and greed. Jesse Livermore understood this implicitly. He didn't just blindly follow the crowd, he studied it. When everyone felt overly safe and confident, he knew to get cautious, to pare back his exposure. And when panic ruled the streets, when everyone else was selling in a frenzy, that's when he was quietly preparing, looking for his next opportunity.
So it's about being comfortable with being uncomfortable, and often being alone in your conviction.
Precisely. To trade successfully over time, you simply must be comfortable being uncomfortable. It means standing apart from the consensus, making decisions that feel contrary to what everyone else is doing or saying. It can feel isolating, and it certainly requires a robust emotional constitution to pull off consistently.
And that brings us full circle back to self-awareness.